Recording first. Hello all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on vital signs of growth, the pulse of India's hospitals. We sincerely appreciate your taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Keshav Gupta, Senior Director Growth, M&A and Business Planning at Max Healthcare Institute Limited. Mr. Krishnan Akhileswaran, Group Chief Financial Officer at Apollo Hospital. Mr. Sameer Agarwal, Group Chief Financial Officer at Manipal Hospital. Mr. Vivek Kumar Goyal, Group Chief Financial Officer at Fortis Healthcare. This session will be moderated by Sabyasachi Mazumdar, Senior Director, and Ravleen Sethi, Director at CareEdge Ratings. We will commence this session with a presentation by Anant Agarwal, Associate Director, and Sanchit Agarwal, Assistant Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in their panel. We will take up your queries at the end of the discussion. Now, may I invite Sanchit to make the presentation.
Thank you, Mamta. Good evening, everyone. India's hospital sector is rapidly growing due to India's hospital sector is rapidly growing due to economic, demographic, and policy factors. Rising income level and wider access to health insurance are reshaping the consumer preference towards private healthcare provider. The sector has seen increased consolidation as well. Considering this development, we at CareEdge Rating thought this is an opportune time to share our perspective on Indian hospital industry. The key messages for today's webinar are: we will take you through the current demographic of healthcare in India and talk about the structural changes that shall drive growth for the sector going forward. Government investment in healthcare and how is medical tourism shaping up and what opportunities it holds. Rising demand should increase the occupancies for player, and ARPOB growth may moderate on higher base but will remain resilient. Hospital chain to report revenue growth of 12 to 14% in FY26 due to rising demand and supported by ARPOB growth, operating margin to remain stable. We will also take you through how soaring cash flow of player have given rise to capex intensity in the sector. Player across the board are expanding, and despite this, credit profile is largely expected to remain stable. The total market size of Indian healthcare industry stands at around 11 to 12 lakh crore. Hospital contribute a major share in the healthcare industry, that is about 60 to 65% at 7 lakh crore, following by pharmaceutical, and the remaining market is contributed by diagnostic, medical equipment, health insurance, and other. The chart on the right hand side presents the compounded annual growth rate of hospital industry during pre-COVID, COVID era, and post-COVID. It is observed that the industry during FY14 to 20 have reported a CAGR of about 10%. However, during COVID, the growth of hospital industry was impacted as the patient have postponed the elective surgery. Nevertheless, with subsiding of the COVID, the growth of hospitals bounced back and thus reported CAGR of about 11% during FY20 to 25. Going ahead, key structural driver about which we are going to talk in a short while as we move ahead in the presentation are expected to aid the industry in clocking 11 to 12% CAGR over FY25 to 28, reaching 9 to 10 trillion. Let us now have a look on current industry landscape. Exhibit 1 presents the percentage share of private hospital to government hospital. Indian hospital sector is more skewed towards private hospital, which contribute about 65 to 70%, while the remaining 30 to 35% is contributed by government hospital. In private space also, large hospital chain account for 13 to 15% and rest are medium to small format hospital. The capital expenditure on healthcare in India has though been inching up over the past years, but remain in the range of 2 to 4% of GDP, as shown in Exhibit 2. This is well below the global average and several emerging peers like Brazil, Russia, Thailand. The consequence of this structural underinvestment is a relatively underdeveloped healthcare infrastructure, particularly in terms of beds and workforce, which we will examine in the following slides. The adequacy of country healthcare infrastructure and personnel is a barometer of its quality healthcare. which can be assessed from bed density, which is bed count, and availability of physician and nurses per 10,000 population. Though India houses nearly one-fifth of the world's population, it has one of the lowest bed density as seen in Exhibit 3. This disparity is even starker in the rural areas as compared to the urban places. Against the WHO's recommendation of 30 bed per 10,000 population, India current density is less than half of that level, translating into a shortfall of nearly 2 million beds nationwide. Further, with only 7 physicians and 17 nursing personnel per 10,000 population as shown in Exhibit 4, India lags behind the global median of 18 physicians and 30 to 35 nursing personnel. This is even lower than the one in developing countries, and hence there is a high scope for improvement and room for more bed and personnel in the country. Having understood the current landscape, let us take a dive into what are the fundamental and structural growth drivers in the industry that will shape and support the next wave of capacity expansion. The prevalent structural and fundamental growth drivers offer huge potential to drive healthcare delivery market in India. Amongst the key fundamental growth drivers are aging population, increasing life expectancy leading to larger population of 45 plus year of age, that is around 30% by 2031, highlighting increased need for healthcare services. Rising income level and insurance penetration, increase insurance penetration from 16.5% to around 40% in a decade, and higher income level result in higher affordability for patient pool. Increase in public health expenditure, government thrust on healthcare infra development through various schemes like PMJ, surge in medical tourism, low cost of treatment with better quality care makes India a preferred destination for medical tourism. Growth in communicable and non-communicable diseases, growing non-communicable diseases and higher mortality rate in India demand the need for better healthcare services. We will explore these aspects in greater detail in the upcoming slides. Let us now have a look on how the insurance penetration has been trending in India. Low in health insurance penetration is one of the major impediment to growth of the healthcare delivery industry in India, as affordability of healthcare facility by lower income group remain a concern. As per Insurance Regulatory and Development Authority, close to 57 crore people have health insurance coverage as on 2024, as against 20 crore in 2014. However, the insurance penetration rate still stood at only 40% in FY24, as can be seen in Exhibit 5, which is far below the penetration rate of 80 to 90% in developed countries. This shows considerable room for growth in the sector. Increasing premium has direct correlation with growth in healthcare sector, as it will result in higher affordability for the patient pool. The total health insurance premium collected remain concentrated amongst the top 5 states. As a result, there is still a sizable population which is yet to be tapped, which will keep fueling growth in the hospital space. In Exhibit 6, gross premium over all these years has been depicted. Health insurance premium increased with a faster rate due to increase in premium by insurer in last 4 to 5 years and reached to 1,19,000 crore in 2025 and has grown at a healthy CAGR of 19 to 20% over the last few years. With increase in awareness of the importance of health insurance policy, we estimate that the insurance premium to grow at a healthy CAGR of about 20% during next 2 to 3 years, which will continue to act as a growth driver for the hospital industry. Let us now have a look at the demographic profile and adult mortality rate of India. With increase in life expectancy and greater number of people going forward entering into the age of 45 plus, the 45 to 60 age group is projected to grow from 11% in 2001 to 17% by 2031, as can be seen in Exhibit 7, while the 60 plus age group will nearly double from 7% to 13%. This aging population will require more frequent and specialized medical attention, including chronic disease management and preventive screening. Adult mortality rate is highest at 219 per thousand population in India, as seen in Exhibit 8, compared to other major countries. It, it is even higher than other developing countries like Vietnam, Brazil. This is due to growing disease and lower healthcare infrastructure availability in India, indicating the need for better healthcare services. In this slide now, we will be discussing the government flagship Ayushman Bharat scheme, which is gaining healthy traction. Exhibit 9, 10, and 11 show year-on-year progress. As on July 2025, over 32,000 hospitals have been empaneled and more than 8.9 crore admission completed by March 2025. With number continue to rise, and Ayushman card coverage has also expanded with over 36.9 crore card issued, targeting more than 55 crore beneficiary. That is around 39% of the India's population. Now, in this slide, we have highlighted PMJ budget trend and participation status. Government allocation has risen sharply from 2,400 crore in FY19 to around 9,500 crore in FY26, with healthcare share of the total budget doubling from 4% to 9%, showing the growing priority as shown in Exhibit 12. Out of the total hospital empaneled under the scheme, private hospital account for 46% of empanelment due to low package rate, delayed payment, high administrative burden, leading to exits in certain specialties. India today see great influx for the medical tourism. India also has a potential to become hospital for the world. Previously, international patients coming for medical treatment in India used to face several regulatory hurdles like regular police inspection. This used to discourage the patient category to opt India as a medical treatment destination. But in recent year, medical tourism in India is on the gradual uptrend, given the relative low cost of surgery, critical care, advanced technology hospital, and e-medical visa. In Exhibit 13, medical tourism has been on rise till calendar year 19 before plunging by around 73% in the COVID stuck year, the year which marked ban on travel and various other restrictions. Year 2022 and 23 mark a significant comeback by the medical tourist, though affected by geopolitical factor to some extent. India ranks among the top 10 countries for medical tourism and is most preferred, especially amongst the Asian countries. Major reason for rising medical tourism is lower cost of treatment in India by more than 50 to 70% compared to that of US and other nations in Southeast Asia. Patients get quality healthcare at reasonable price, and the medical tourism industry is expected to grow further, driven by the Government of India initiative like Heal in India. This particularly benefits the hospital of metro cities the most, as they are the primary beneficiaries for international patient flow. Nearly 85 to 90% of medical tourists arriving in India are from countries like Africa, West Asia, and other South Asian nations. Also, medical tourists arriving from developed countries like UK, Australia, and Canada are on the rise. This trend is expected to remain a key catalyst for growth in India's hospital sector. In the current slide, we have depicted the emerging trend in the hospital space. The next phase of hospital transformation will be technology-led, with AI and robotic surgery enhancing clinical precision, electronic health record and radiology information system driving efficiencies, and telemedicine, wearables, and mobile health apps expanding patient access and engagement. Together, these digital levers are reshaping both care delivery and operating models, positioning technology as a core growth catalyst for Indian hospital. From here on, my colleague Anant will take you through the operating and financial metrics of key players along with the credit dispersion in the sector.
Thank you, Sanchit. Let us now look at the operating metrics of the hospital sector. For this, we have considered sample size of 9 major listed companies, which together represent 80 to 85% of the listed hospital space. Moving on to next slide, one of the most critical benchmarks of hospital performance is bed occupancy. If we look at the trend, occupancy rates have steadily improved post-COVID, and they are now stabilizing at 60 to 64%. What is important to note here is that stability is being maintained even on a higher bed base. This study performance supported by several factors we have discussed earlier, such as rising health awareness among demographies, greater insurance penetration, increased chronic ailment, and a change in case mix. And lastly, growing traction in medical tourism. Alongside occupancy, we must also consider average revenue per occupied bed, or ARPOB. So ARPOB is a function of case mix, payer mix, price hikes, and the growing share of complex surgeries. In the last few years, hospitals have steadily increased ARPOB, supported by higher insurance adoption and a shift toward higher-end specialties like oncology, neurology, and transplants. Going forward, ARPOB is expected to grow at 5 to 6% annually over the next few years. This steady growth in RPOP has strengthened cash flows across the industry, setting the stage for a new capex cycle, which we will see in the next slide. Moving to the next slide, the industry today is at the beginning of the fresh capex cycle. Post-COVID, hospitals have witnessed a sharp improvement in cash flows, and this has given companies the confidence to expand aggressively. Both greenfield, brownfield, along with many asset-light operating models are being announced across geographies. The 9 listed player alone expected to add 14 to 15,000 bed over the next 3 to 4 years. Let me put these numbers in context. In FY25, total bed capacity stood at approximately 43,500, an increase of 8% over the previous year. Operational bed have consistently remained at 80 to 85% of the total bed capacity. By 2028, total bed capacity is projected to reach 57 to 58,000 for our sample set of companies. What is interesting here is a clear shift in growth model. Earlier, the growth came largely from RPOP, even though the volume were rising steadily. In the current phase, the growth will be driven mainly by capacity expansion, a strategic move by the industry to cater to rising demand and ensure a widened coverage across region. Moving to next slide, let us look at the payer mix of the sector. As per our analysis, cash and insurance together form the bulk of industry's payer mix. Firstly, cash and self-pay remain the most efficient option since payments are received almost immediately. Insurance share is steadily rising, backed by deeper penetration. The collection cycle for insurance claim is typically 30 to 50 days, which is longer as compared to self and cash pay, but remain comfortable. And lastly, international patients are steadily rising over the last 4 years. This is a higher margin segment, and the collection cycle is relatively short, making it an attractive revenue stream. Going forward, we expect the share of insurance and international patient share in the overall mix to rise, driven by expanding insurance coverage and India's growing attractiveness as a medical tourism destination. Now, let me update on the financial profile of the hospital sector. Moving to next slide, hospital sector revenue has grown at a CAGR of 15 to 16% post-COVID. Looking forward, we expect the strong momentum to sustain at a CAGR of 12 to 14% over the next few years on account of higher bed base and capacity expansion. On profitability front, operating margins as seen in Exhibit 19 expanded by nearly 10 to 11% between FY19 and FY23 and have sustained since then. The significant improvement came from operating leverage, cost optimization, and steady ARPA growth. Margins have stabilized at 22 to 23% in the recent years and are expected to remain in this range even as new capacity will be added. Refer to Exhibit 20. What is important to note here is that while operating bed capacity grew at about 3% CAGR over the past 6 years, EBITDA expanded by over 20% annually. This pushed EBITDA per operating bed up sharply from rupees 1.9 million in FY21 to rupees 4.7 million in FY25. Going forward, the key challenge will be to sustain these strong per bed profitability as capacity expand. Additionally, the support for margins will come from changing payer mix, particularly the rising share of insurance and international business, which help margins to maintain even with the added cost of expansion. Moving to next slide, on refer to return on capital employed or ROC. Hospitals are higher gestation businesses where greenfield projects typically takes 3 to 5 years to break even. Historically, this has kept ROC levels subdued as seen in Exhibit 21. However, with improved operating margins, ROC recovered strongly to 14 to 15% during FY22 to 24 period. During FY25, we saw a moderation in ROC as company resumed capex. Going forward, with more capacity addition expected, ROC is projected to stabilize at 11 to 20% over the next 2 years on an average across our sample set of companies. Although this is below recent peaks, it is still well above pre-COVID levels, signaling a higher return profile for the industry as compared to last decade. Another important data point is leverage. Improved profitability and stronger cash accruals enable hospital to deleverage significantly in the past few years. Net leverage stood at 4.6 times in FY19 and improved sharply to 1.24 times in FY25. In FY25, leverage did increase slightly as companies begin debt-funded expansion. Going forward, leverage may marginally rise as debt will be taken up for new projects. However, as cash accruals remain strong, majority of the capex in the industry is expected to be backed by internal accruals, keeping the leverage levels comfortable and when within manageable levels. Moving to next slide. At CareEdge, we currently rate around 92 hospitals across small, mid, and large entities. Nearly 79% of our rated portfolio is in investment grade category, that is triple B and above. Within this, 55% is in A or AA category, which reflect the strong financial health of many players. In terms of rating actions, the sector have consistently shown resilience. Post-COVID, the credit ratio peaked at 11, meaning 11 upgrades for every single downgrade. Even in FY24 and 25, the credit ratio remained healthy at 6 to 7 times. This demonstrates a robust credit profile of hospital sector supported by solid demand fundamentals, improved financials, along with other positive factors driving the ratings. Now comes to rating driver and monitorable for the sector. So growth driver includes firstly, rising demand through higher insurance penetration and greater health awareness. Second, medical tourism, where India's cost advantage compared to developed market is drawing global patients. Thirdly, the growing specialty mix and ramp up in diagnostic, which diversify revenue stream. And lastly, the technological adoption. Robotics, AI, telemedicine, digital health, which are improving productivity and transforming healthcare delivery. On the risk side, regulatory intervention remain a key monitorable. Any adverse measures such as stringent price cap can impact pricing power or margins. Secondly, event-based risk, including litigation or reputation challenges, must also be managed carefully. Thirdly, debt-funded expansion, acquisition, if aggressive, may weigh on credit profile. And finally, there is a challenge of skilled manpower availability. Expansion capacity will require high quality healthcare professional, and that comes with a higher cost. So balancing the pace of expansion with the availability of talent will be critical for the sector. Before I close, let me highlight that India hospital sector is in strong growth phase backed by robust operations and investments. Sustaining this momentum will depend on managing regulatory risk, leverage, and manpower cost. With this, we came to the end of this presentation. Over to you, Mamta. Thank you.
Thank you, Sanchit and Anant. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Ravleen and Sabyasachi to take over the session, please. Sabyasachi Mazumdar is a senior director at CareEdge. He has over 25 years of experience in credit rating and sectoral research across diverse sectors such as power, renewable energy, cement, sugar, chemicals, oil and gas, etc. He is an alumnus of IIM Lucknow and Delhi College of Engineering. Ravleen Sethi is a director at CareEdge. She is a qualified chartered accountant and has over 14 years of experience in corporate accounting and credit rating across diverse sectors such as cement, hospitality, healthcare, and sugar. Over to you, Ravleen.
Yeah, thanks, Mamta, for the introduction and wonderful presentation by both Anant and Anant and Sanchit, which sets the context very beautifully for our session today. Good evening, everyone. We are delighted to be joined today by some of the most respected and industry-leading leaders from India's top corporate hospital chains. It's an honor to have such an eminent panel with us. I will now take a moment to introduce them in alphabetical order. First of all, we have Mr. Keshav Gupta, Senior Director, Growth, M&A and Business Planning with Max Healthcare Institute Limited. Keshav leads the investments, business intelligence, and planning vertical at Max Healthcare. He has over 20 years of rich experience in investments, M&A, and he brings a strong set of skills and perspectives to the organization. He has a strong record of accomplishments in leading large transactions in large format businesses. In his previous role, he was leading the commercial operations and growth verticals for a South India-based hospital and pharmaceutical organization. He holds a bachelor's degree in computer science from IIT BHU and MBA from FMS Delhi. Good afternoon, Mr. Gupta, and welcome to the webinar, and thanks for taking your time out for joining us. Our next participant today is Mr. Krishnan Akhileswaran. He's the Group CFO of Apollo Hospitals, India's leading private sector hospital and pharmacy operator. Key membership of the leadership team of the company, Mr. Krishnan is responsible for the group's overall finance, capital allocation and strategy, growth and expansions, M&A and investor relations. Prior to working at Apollo Hospitals, he had over 25 years of experience in finance in various organizations such as M&M, Leo Burnett, and ICICI OneSource. He holds a bachelor's degree in commerce and an MBA in finance, both from the Bombay University. He's also a qualified cost and management accountant and certified treasury manager. He has received many awards and recognitions in his workplace as well as renowned industry bodies. More recently, received the CII Healthcare CFO of the award in 2022, the Economic Times Best CFO of the Year Large Enterprises Award in 2023, Business World Best CFO of the Year Large Enterprises Award in 2024, Transformative CFO Award from HR Association of India in 2025. Welcome, Mr. Krishnan. Welcome to our webinar, and thanks for taking your time out to join us. Our next guest is Mr. Sameer Agarwal, the Group CFO at Manipal Health Enterprises Private Limited. He's a CA by qualification and has completed his bachelor's in commerce from Narsee Monjee College of Commerce and Economics, Mumbai. He comes with over 27 years of diverse industry experience ranging from healthcare conglomerate, FMCG and industrial companies, working with leading Indian blue chip companies such as Marico, American MNCs like 3M India, Ingersoll Rand, Hindustan Coca-Cola, and has worked with multiple locations in India and abroad. He has extensive experience in M&A, treasury, F&A, controllership, investor relations, private equity, digital finance and business transformation. And prior to MHEPL, Sameer was associated with 3M India Limited, where he was the CEO. Good evening, Mr. Agarwal, and welcome to our webinar. Our final participant today is Mr. Vivek Kumar Goyal, CFO Fortis Healthcare Limited. He's a seasoned professional with over 30 years of experience in finance. He joined Fortis Healthcare as a group CFO 4.5 years ago. And prior to joining Fortis, he has worked with various companies like Tata Housing and Development Company, Ballarpur Industries, Saw Pipes Limited, and Indo-Asian Fuse Gear Limited. He's a qualified CA and a company secretary from the ICSI and holds an LLB degree from the University of Delhi. Mr. Goyal, good evening and welcome to our webinar. So I'll now hand over the stage to Ravleen to start the panel discussion rounds.
Yeah, thank you, Sabyasachi. Thank you all and welcome on our panel. So just to open the discussion, and we've already had the context set with the presentation, I would like to pose the first question to you, Keshav. From a strategic landscape perspective, as we've seen the presentation and as the sector scales, how do you see, the growth trajectory unfolding over, say, next 4 to 5 years, especially, while we are talking of balancing the high-end metro hubs with the untapped potential of the tier 2, tier 3 cities, where we now see the players taking up the capex?
Thanks, Ravleen, for having us all over here. So I think the answer is pretty one is the supply side, that all of us have to find the right answer. There are 3 key questions, right? What services, in what patient experience, quality, and third is at what financials, what price point, what yields. So given the 1.5 billion population, slightly more aware, slightly more accessible, slightly more connected, trains, flights, roads, and slightly more needy. Like I think Anant mentioned that we are all aging. about 30% people above the age of 45 in India, with a population of 1.5 billion base. There is so much need. It's not a plan that we need to execute. It's a need that we need to address collectively as a society. So unless we all create those beds, I think we are underpegged at 15,000, which your colleague mentioned, Sanchit mentioned that we are adding about 15,000 beds in the next 3 or 4 years. We'll be so far behind the demand side that unless we accelerate this path with various government incentives, initiatives, all of us thinking together on which markets, how to grow, how to service those markets, we'll be far behind the demand. So it's not as much of an outcome of what strategy, where do we grow. Wherever we have the right balance sheets, whatever exposures we collectively are okay to take, we'll have to address those markets. Yes, like any other industry, it has to be clusterized to one zones, and hence metro, tier 1, tier 2 towns, appear more in all our collective target lists than a tier 3 town correctly, because the balance sheet also has to yield to a P&L. But there is no doubt in anyone's mind, I hope, I believe, about what the need of the hour is. Even if we age collectively today at the same rate of about, every 10 years we age by 5-6 years, given the death and the birth rate, and every year of extra year to our collective life adds 2 to 3% of hospitalizations. That's significant more pressure on the entire system, government and private and PPP combined. Obviously each one of us, like, we have a certain path to urban clusters, more centric to metros and tier 1 towns. Some of us have a path to tier 2 towns because the business model works for them.
Okay, so thank you. So it's like the takeaway is we are expecting a two-track market maybe, wherever the tier 2 and 3 could be the immediate growth frontiers for the volumes of the bed additions. And like you mentioned, the metros would continue to grow, maybe, the 60-70% capacity is still coming up in the metros only. Right?
It's easier to deliver the business, right? It's because the doctors kind of stay put there. That's where the social economic circumstances are better. There'll be better malls, better colleges, better schools. Like any analyst, any investor who makes money would go to a New York or a LA, but not to the upcountry in US or India. They'll tend to stay in Bombay and Bangalore and Pune and Delhi. So would doctors, and hence the delivery of services better in such towns.
Sure. Mr. Krishnan, let me bring you in over here. What's your perspective? You have similar thoughts as Keshav just said. And also, apart from that, we do understand, like, RPOB is a very important, it's a factor of a payer or a case mix, and, not just the price hikes taken by the hospital. But as we go into the tier 2 and 3, would the RPOB growth, would be plateauing over the next 2 to 3 years, considering the base is already high? Or even if RPOB is the most commonly quoted metric, but is it always right lens, when we are looking at tier 2, 3, or obviously, EBITDA per bed, ROCEs are the other yardsticks. So can you throw some light, please?
Sure. Thank you so much. I think thanks for the question. And clearly, I think we would like to, while yes, on one side, the metros are seeing a lot of supply from all of us. The tier 2 does represent a very strong opportunities. And when we say tier 2, we mean, the state capitals to begin with, right? If you look at, for example, Apollo today, we have 4,500 beds in metros and over 3,500 of the beds are in non-metros. Non-metro, because, care has to go closer to the patient. There's no doubt about that. Today, yes, for whatever reasons, as Keshav said, also, there are a lot of talent pool which is available in metros, which resulted in a lot of concentration of these beds in metros. Tier 1 metros itself needed most of the beds. But then tier 2s and even the state capitals, when we say tier 2, there's such a large population in the tier 2, and we are all going to be definitely getting into tier 2s in a much larger manner over the next 10 years. May not be in the next 3-4 years necessarily, but if you look for the next decade, care has to go closer to where it is required the most. For example, even a case in point, given that all of us are here, Lucknow was a city that all of us had forgotten for a long time, as Indians. But I guess, we all, we started the first hospital, then you have Medanta, which put up another hospital. Max has one, maybe he's going to be putting two. So, I'm saying there are so many such towns which are all hidden. And I think all places we do see that there is a need. People are traveling all the way to Delhi NCR or Chennai or Bangalore for care. slowly it needs to percolate there. There's no doubt about that. RPOBs, of course, see, as you said, ROI is the only measure, in my opinion, for every business, right? Finally, that's the best measure which brings into perspective your investment versus the returns that you make, right? Wherever it is, for example, in a pharmacy business of ours, which is not related to hospitals, our EBITDA margins are 7%. At 7% EBITDA margins, I make more ROC than the hospital business. So which is the better business? I don't know. You answer. So I'm just saying that EBITDA margins are just a perspective. RPOB again is a very mixed perspective, right? Your analyst correctly stated that RPOB is a measure of too many things. It's not just pricing, it's about case mix, it includes OP, IP. We do so much of radiation oncology in oral hospitals in our metros. All of that is part of RPOB. So it's just a measure of total revenues divided by the operating bed, which just provides you a perspective of how what is the revenue intensity in that hospital, not necessarily the average revenue per patient, etc. So it's a very important measure, because it's important that your viewers also know this, because many people today, the media particularly, are looking at RPOB and thinking that that's what that they mistake it to be a pricing lever. It is not. For example, if you look at our average revenue per patient, we have taken off RPOB from the last investor presentations, and necessarily so, because we believe that the media is unfortunately otherwise overly highlighting on RPOBs. If you look at the average revenue per patient that at an Apollo, and it will be very similar in all the other listed peers also, 70% of the patients coming into our system pay less than 2 lakh rupees. 70%. 90% of the people pay less than 5 lakh rupees, and it's only the last 10% who pay more than 5 lakhs. Whereas, the general perception is that the Indian hospitals are very expensive. It is expensive when it comes to above a 5 lakh rupees claim, but of course, that's why you need to cover yourself with insurance and other products. Hopefully, that's getting more and more popular. But the vast majority of what we are treating are definitely at the 2 lakhs, 3 lakhs, or the 5 lakhs and below. And it is required, because it's a tertiary care setup that we all have set up. Technologies are high. So, I guess just give you a perspective of RPOB. But then again, as I said, when it comes to a tier 2, our cost of setting up a hospital will be lower. The average revenue per patient will be lower. RPOBs will be lower. But hopefully our ROIs will still be good. Just to give you multiple different things for a question that you asked.
No, we appreciate those perspectives. So capital efficiency will be superior, even, as these hospital chains, scale up in tier 2 and 3 as well. I'm sure very helpful for our audience as well. Mr. Sameer, we move to you, and maybe, you take this on the strategic landscape in the hospital space. We cannot leave out this topic, which is consolidation. And it's a very recurring theme, in our credit conversations as well. So, with all that is happening in the hospital space, I mean, we do have these corporate chains may not be contributing more than 15% right now, of the hospital space put together. There is a large untapped market, but the degree of consolidation which we can see right now in the sector, do you believe, India is heading towards a 4-5 mega hospital platforms chain? Or will these specialty regional players will still, hold strong 5-10 years down the line? Like, how do you see the space?
Yeah. Thanks, Ravleen, and thanks, CareEdge, for having us all here. If I had a crystal ball, I would have been Mukesh Ambani. That is what I can say, that if I knew what's going to happen. But as we see it now, Ravleen, to be honest, as you rightly said, in fact, the people on this call, or the organized corporate hospital chain, maybe less than 10% of the overall beds. It's a very fragmented industry. If you look at healthcare as an industry, we would be like a sunrise industry. Maybe the last 15, 20 years, I think so. Maybe Apollo started this trend much earlier, but I think so. We all have the corporate hospitals have started growing in the last 10, 15 years. With significant investments coming from the PE. I think so. That's again one of the topics that everybody is interested in knowing. That's because all the hospitals are extremely capex heavy. It's sometimes when I tell people, and people lose the trust in private healthcare in a bit, saying how much margins you make, people forget to understand the kind of cost that is incurred for actually even putting up a hospital, right? Depending upon where you are putting up the hospital, it can cost you anywhere between 2 to 3 crores a bed without even the land costs. So efficiency of capital, I think so, which is your prior question that you sort of put. because of the high capex investments, and I think so practically no benefit that we get from the government, right? We don't, there is nothing that is built in for hospital setting up in a tier 2 or tier 3, and that is something that I will really advocate at some point when we wanted to grow the tier 2 and tier 3 cities in the country. A lot of benefits were given to factories and FMCG companies to setting up factories with zero excise, zero GST, zero income tax. But I do not see anybody talking that for healthcare at all. And healthcare is as much or even more capex heavy. It provides definitely much more employment directly and indirectly, because each hospital bed typically, depending upon the hospital, has 4 or 5 people per operating bed. That is sort of put. So each hospital, even if you put a 500 bed hospital, will typically have 2,500 people working for them. Looking at all of that, I still feel that there is a large play by everyone. Ravleen, I do not think consolidation. India is still far from that. I think so. Keshav put it well, and so as that we are still far behind. And one of your analysis still shows that we are, the kind of hospital beds per 10,000 that India has is even below. It's equivalent to Pakistan, which is actually it's really down, right? We have not invested as public healthcare sufficiently in capex. Capex is very heavy, and I think so. Regional chains will be there. I think so. There is a place. I personally believe that there is a place for everyone to deliver quality healthcare or quality business to wherever they operate. If they operate in a manner that gives quality healthcare to the patients at a reasonable and affordable cost, I think so everybody can succeed. Single specialty, for example, a lot of people believe there is no room for single specialty. I don't think so. That's correct. A lot of single specialty, in fact, they are projected to double in the next 2 3 years, where single specialties like cancer and even mother and child programs are doing very well. Like companies like Cloud9, etc., have set up more than 30, 40, 50 centers across the tier 1, tier 2, and tier 3 cities across. Yes, there will be consolidation, and in fact, sometimes some of this consolidation is good for the country as well, because it brings in, it allows economy of scale. It involves that a lot of new technology is gotten. Technology is very expensive in the hospitals. All the technology today is imported. We hardly have any made in India technology in healthcare. All the technology is imported. So it is important that we have scale for us to provide the kind of quality to our citizens as well as to the medical tourists that is available anywhere in the world. For that, the size of scale is important because of extremely high people as well as capex involvement. But I, Ravleen, still feel that there is some time because we are still less than 10% of the overall beds. For in the next 4 5 years to make that happen, I don't think so that will happen so fast. Will the consolidation happen? It might, because people may not be able to invest in the absolute technology as much as a big hospital corporate chain. But I think so still some time to go, and there is still place for the regional chains to do very well.
Sure. No, we've seen private equity investments also coming up in the single specialty hospital as
Yes.
well. There have been many deals last year. So
Yeah.
like a large pan-India platform which would be complemented by a resilient specialty and regional leaders is how you like the takeaways that we see the
In
sector.
fact, Ravleen, I do not know, I don't speak for all, but I'm sure my colleagues will agree with me. In case if there are quality regional health chains and corporate chains in tier 1, tier 2, it makes for other people to come in easier, because
Sure.
you have doctors available, you have the corporate culture available, the patients know what they are paying for, the trust in the medical system is sort of set up. So the more, and to be honest, when you talk about tier 2, tier 3, it cannot be talked about without the infrastructure development in the country, right? You have to have medical colleges across the country. You should have a good primary and secondary healthcare center before a private healthcare can even, people like Keshav can even put up an, acquisition notice. You have to have the, things put up. You should have doctors available, nurses available, and all that is an overall ecosystem. And that is something I still feel as a country we
We
are
are
not
far behind.
investing in the healthcare ecosystems, and we are hoping that the private healthcare does it. And with private healthcare comes expectations from the market. Most of my panelists are listed, and they go on to calls quarterly. So it's important that one understands all of this before we decide to put that entire onus on private healthcare.
No, sure. Thank you. Thank you for those insights.
Yeah.
So we stay with the consolidation theme, and let me bring in Mr. Vivek over here. Vivek, greenfield hospitals and metros, typically take 3 to 5 years to break even. In tier two, three, it may be quicker. So do you see consolidation, with these corporate hospital chains becoming a faster route to capacity expansion than the organic build-outs? Or because, in contrast, acquiring a well-run regional hospital gave us an instant capacity, an established brand, a clinical team. So what's your take on that?
Yeah, thanks, Ravleen, and thanks for having me on this webinar. And I agree with most of the points Samir has said. And for growth actually, and to growing the healthcare chain, I will say the easiest way is the brownfield, which is expanding the brownfield wherever possible. So as a hospital chain, we have taken that route first, and that is, I will say, low hanging fruit and easy to implement also, cost wise also, and post capex ramp up also. And the second in line, I will say, is from the cost wise, it is greenfield, and from the speed wise, it is acquisition. And I will say for the hospital chain and most of the player who are here on this webinar, all three are very important. And I see there is a consolidation possible because there are still standalone hospitals, and in the clusters we follow cluster approach. In the cluster we operate, and they want to associate with the corporate like us and a big hospital chain like us, whereby we can add lot of value for their hospital chain, and also for our network also. So I feel there are a lot of scope still in all three verticals.
I think so. Ravleen, Vivek has said it. I think so. Over to you. I do not know. We have lost Ravleen, Sabyasachi.
Looking like.
Yeah, and Sabyasachi, you are on mute, so we can't hear you as well. Yes.
Oh, Ravleen, you are there?
I think so. Her
Network problem, I believe.
We have to solve for this as a country first.
That's what.
Sabyasachi, you want to lead?
Yeah. So
Yeah, she's back,
actually,
she's
I had a
back.
couple of questions, Ravleen. Maybe I could begin with Mr. Gupta. So what do you see as the top 2, 3 systemic risks for the Indian hospitals in the next decade? And another question I had for you was that, some of the high performing regions like Delhi and Kerala, they have very good, talent pools. But how do hospital chains plan to staff, their expansion into tier 2 and tier 3 city? I mean, what would be the strategy that you'd follow? Would training, anchor hiring, AI augmentation? If you could just shed some of this light on some of these, like systemic risks, and how do you, plan to address the talent pools?
Sure. One by one. So, systemic risk, other than the internet connectivity across the country, which seems to be an issue, but there are a couple of different initial points. One, obviously, I think all of us are seeing is that there is across industries, be it engineers, MBA, engineer, grad, everything. Getting a degree versus getting an applied understanding of sciences on that. Same for non-medical and medical manpower, nurses, GDS. There seems to be a gap for whatever reason. Patients tends to, like honeybees, clusterize to few doctors, few talent pools, and that dissemination has to happen. If we have about 10 lakh plus minus 5-10% doctors across the country, a very large number of them don't tend to be in the same league for whatever reason, where a few of them will have, like any other industry. So that dissemination of skill set has to happen, and we have all found our answers to that, right? We are all having DNB programs, nursing training colleges, partnerships, everything. But that needs to be solved for collectively. If we have a throughput of 1.5 billion people coming for treatment, currently only about 1/5 of them actually use the services, technically once in a year. So that needs to change with a very large impetus and government is doing their best. They can't do more. They're putting up colleges in every district. They're getting students in. They have the grading marks also with some question on the merit, but that needs to be solved for. And the same also holds true for tier 2, tier 3 towns. We need to provide ecosystem for doctors and nurses and for non-medical staff to stay in those towns. Like Lucknow, few urban clusters like Indore, Pune, Bangalore, Chennai have solved for it. Madurai, Kochi have solved for it, but not all tier 2 towns. We need to have the infrastructure of colleges, schools, road connectivity, trains, airports. It's a 5 to 15 year schema.
Yeah, I
The
can
second,
understand with the length of the medical training cycles, and also it is a fairly long gestation project.
the second one, just to because already I think Krishnan and Samir mentioned on that. Yeah, so there is a lot of hue and cry about the industry as a whole. One, because it is a layman's, everyone gets touched by this. The RPOB being seen as the price point. RPOB is not a price point. You can't do more than inflationary increase. Index was at 8,000, like not more than 12 years back, or 20,000, like if you do Sensex, it's like 4 times now. RPOBs are nowhere in that league. We can't say roti was 1 rupee a roti earlier, now it's 20 rupees in a restaurant. We don't question that. So the hue and cry because of various single different elements, be it government sector price point, Ayushman Bharat different price point, that has to be solved for as a system, as an environment, so that we don't start looking at it with a very different lens. There is no profiteering. Your slide showed 11% ROCE here. At 11%, industries would fail globally. 11% ROC is not for the industry average. Some of us make more or less, not because the price point is different, but because the clinical services are different. So I think that the image has to be changed and one has to understand with a deeper lens on the numbers.
Over
to others, I guess.
the same question I have for Mr. Krishnan as well. Do you concur with Mr. Gupta's views on this? And what are your views on the talent, the regulatory changes, and the technology challenges that that the Indian hospital sector faces in the coming decade, and how are Indian corporate hospital chains preparing to manage these challenges?
Thank you. Yeah, I think definitely there are, if you look at the systemic risks, I think the regulatory risk will always be there because it is a social sector, right? And because it's a social sector and it's for the vast majority of India, it's easy to bring focus and attention towards the hospital industry, which we should again appreciate again in some way or form that various ways. If you look at it, 1/10 of the global prices is what we are still working at, while most of our input costs are all at the same prices. If you look at it, land and building in India is as high as wherever it can be in the world or higher. All our equipments are imported. So at that point in time, at this scale, we are only able to give at 1/10 of the global prices because of our scale and volumes that we are able to see as hospitals. It's important that that scale and volumes continue for us to be able to sustain at this prices, which has to be enabled through insurance penetration, more and more per capita income, etc., which all needs to hopefully fall in place. We are all, I think, looking forward to that. That's but the regulation is something that we should always keep our eyes on because, we keep educating even the government that what we are all doing as hospitals are definitely normal ROIs, which has already been highlighted. Putting up a hospital today, I think the systemic risk is if you look at the cost of setting up a hospital today at 2.5 crores to 3 crores a bed is what we are now running at metros. It's not a small cost at all. To put up a 500 bedded hospital in a Gurugram or a Delhi or a Mumbai is going to be 1,500 plus crores. In a tier in a Chennai or a Bangalore will be 1,100 crores. It's not small. And we have to make the ROIs of 15-16% at least over a period of 10 years. It's going to be, we will see that ROI only after 10 years. It won't be for earlier. So that perspective has to be clearly understood by regulation. The second systemic risk, if you look at it, is the speed of technology. I think somewhere, many people don't understand that, people like us put a lot of technology for outcomes. We have been the earliest, India has some of the best, I think we have robotics now across all our hospitals. Earlier we didn't have robotics. Each of the robo costs more than $2 million. If you look at some of the Linac machines for cancer treatment, if you go back a decade back, the Linacs were not priced at the levels at which they are priced today, because the medical equipment manufacturers have embedded so much of technology and advanced features in the Linacs that today a high-end Linac can cost as high as even 30 crores. Whereas, probably if you look at it, it was around 10 and 12 crores around a decade back, the highest end Linac. So which means there is so much of technology which is getting embedded for betterment in outcomes. It's very difficult for players like us to not embrace it. And, because we genuinely believe that we don't want people to go outside of India for care. We are really doing the best within the country. And somewhere I think rather than we being defensive, we need to take pride in this sector, which has really, created some of the best infrastructure for India and for Indians. But that systemic risk of technology obsolescence is going to be more higher, because with AI embedded technologies which is going to be coming, we need to ensure that not only do we embrace these technologies earlier, we need to also absorb it and get, be able to change it in 8 years. It's not an easy thing, which means, it's not at all easy given the kind of pricing that we are today working on. We are expecting most of these technologies that we bring in to be there for 11 and 12 years. Whereas, 7 and so that obsolescence is a systemic risk that we should be worried about. It's important that people like us are able to sustain that kind of momentum, as a hospital. The third important thing, which already I think many of my peers have said, is talent. Getting a good talent pool is very, very difficult today.
Yeah.
I think it's very important that we understand that unlike engineers, the number of doctors that the country has or country generates are very little. And I just hope that, we put more at it to be able to double the workforce of doctors in the country over the next 3 and 4 years. That's the 2 or 3 systemic risks that I do see, and we should be addressing that as a country.
Since you touched upon AI, so I had one small question, before I go to the audience. Do you see AI as a margin enabler, or do you see it as a upfront cost burden, before it starts paying returns?
Very good question. Very difficult to answer. It is it will hopefully have to help us bring down the, costs with time. But today, as we see it, AI embedded care is increasing the cost because, the medical technologies are all embedding AI. So on top of the AI, we have talent. It is a very difficult, I'm not able to see how the AI with time will probably bring it down. But when it goes outside the hospital setup, etc., when you're able to keep people outside healthy with AI, maybe that's the place where, you probably AI will help us bring down or make us more educated so that less people fall ill, etc. But in the hospital setup, for now, it seems like it is adding to the cost. I will allow others like Samir or Vivek or to respond as well to this.
No, Krishnan, I don't think so. Again, Sabyasachi, it's all about cost, right? When you embed technology, when you embed AI, it's about quality outcomes. And I think so, as Krishnan pointed out, and all others know, we are 1/10 of the cost of the global world, right? In fact, our costs are even 80% cheaper than even Thailand. Forget about the West markets. So I think so. Looking at only cost is self-defeating when you're trying to invest into technology which can improve the care in India to ensure that the Indians don't have to travel abroad for any care. According to me, more than 95 to 98% of everything that is happening globally can happen in India today. And as we get to more make in India technology, as you know, again, the entire technology in healthcare is today imported. The rupees at 89 rupees, right? So something that gets cheaper gets more expensive through import. But I'm saying it is the quality of care and the quality of outcome and reduced number of days stayed in the hospital, which is an outcome which sometimes we don't talk about and we don't get enough credit as a hospital organization, as Sabyasachi. So it's not all about bringing down the cost using AI or technology, would be my view.
Okay. No, thanks, Samir, for those insights. Coming back to the capex expansion, since we were already talking to Vivek, and probably I got dropped off, so sorry about that. What we take away, on the capacity consolidation, Vivek, your point was that, the end game was whether it comes from acquisition synergies or optimized build cost. I have a question here, and maybe, Keshav, we bring you back into the discussion on the capex leg only. A very interesting point is today hospitals, they are balancing the greenfield, brownfield. We see a lot of asset light things coming, such as O&M, lease, and franchise. So, operator light models where hospitals manage these third party facilities. Do you see this becoming a significant growth lever? Uh, what is your thoughts on the same? Expansion mode for the hospitals. Maybe you want to break them into buckets of tier one, tier two, tier three, or how would it be?
Yeah, so we are not banking on O&M type of model to a great extent, and our am I audible now?
Yes, yes, yes,
Yeah,
you
great.
are.
So we are not banking too much on the O&M model, and I feel that more and more, the new technology is coming, and the type of investment is required. The O&M model in the true sense may not be workable, because healthcare, as all of us are saying, require a lot of investment, not only at the time of setting up the hospital, but
Hmm.
after setting up the running up of the hospital. As
Hmm.
Krishnan says, the robotic surgeries, every day the technology is changing, all the equipments are imported, and all those things cost a lot, and justifying that cost to a non-operator may be difficult. Okay, and that's why, O&M model, in my view, is not sustainable in a long term. And I feel there is one need to take a balanced approach for the growth. There is a ample demand for the healthcare sector, and for meeting that type of demand, I think all levers should be used. And in my view, the brownfield and greenfield is the easy one to handle. Sometime, because of the expectancy for the acquisition opportunities, the valuation has skyrocketed, and most of the cases, it may not make financial sense to bid beyond a particular type of thing. So that's why, for organization like us, we feel brownfield and greenfield is the best option, and we will be opportunistic for the acquisition bid.
No, no, we agree. It's not a silver bullet. Keshav, you have similar thoughts on the expansion mode, outside consolidation, Would like to hear your thoughts as well.
I think collectively all of us have certain lines of understanding that we work with. So broadly, if the industry is at 10% organized, large, accredited, calibrated, rated, reviewed players, and 90% is unorganized, those players tend to come to the 10% players, okay, help us run it, maybe buy me out, maybe do something. When the price point becomes irrelevant, or the counterparty, small 100, 150 bed hospital, says that I don't want to exit now because there's a lot of value I'll create. Plus, none of us have the manpower to deploy in a tier 2 town readily available, right? Bench strength. We would rather partner with the gentleman by way of acqui-hiring, by way of arrangement, expansion contracts, O&M contracts, and yields are to be solved for by saying what yield to whom. If someone puts money, there's a benefit of that. So P&L cutting is different. Can slice the watermelon whichever way. But there are 3-4 key buckets. I think all of us have the same thing. Yeah. So if we have our own asset running hospital, brownfield is the easiest bucket to grow. So yes, collectively you hear that from everyone. A full hospital having more high occupancy, high yields, put more beds because that's a doorstep demand. The second and third is where the complications come in. You go to a new town, you don't have the skill set to create a facility. All of us are operators, but not necessarily the best developers to dig the hole, brick mortar, get the approvals, get clinical teams in, and then start and open the keys. We are dividing it into two parts. One is get medical teams run the hospital, and the first is create a hazard. So that's where we partner. So I think Bangalore, Pune, more collectively, all of us have a lot of partners to shake hands and say, hey, I'll build the hospital for you. After building it up, I'll sell it to you, or I'll give it to you on the long-term annuity contracts, revenue share, rent, or O&M partnership. You can call it whichever. The third is where the acquisitions are coming in. That can be the core strategy. Acquisitions come in once in a while, right? Your strategy has to be your own, that brownfield or capex or buy land or not buy land or partner. Acquisitions, when they come in, yes, in the long term, I think back in the days, you can ascribe anything to Edison and Einstein. someone said that in the long term, the role of the government is to depreciate money, right? So money's become cheaper, valuations have become more, yields are more, ARPOBs are more. So that's why the valuations are more. Indexes are 80,000 now, 4 times in the last 7-8 years. So one has to pay for it. And yes, at certain point, the ROCs don't come and make sense. So whoever thinks there's a value I can create from the asset, they'll buy. Consolidation will happen, like Samir said, in the next 5 to 15 years. It has to go from 10% organized to 30-40% organized over a decade and a half. There is no way around it.
Sure, sure. Mr. Krishnan, we would like to hear, the expansion thing is happening, and earlier point that we touched on with Keshav and you on the expansion happening more in metros. Now when we see at the data points of what India from an infrastructure perspective is underpenetrated, the bed density is well below the WHO norms, but the gap is more acute in the rural and the semi-urban areas, right, where the aggressive expansion is still concentrated in the metros, like we just spoke, maybe 50-60% of these corporate hospital chains, obviously the listed space we are talking, it's still coming in the metro. So, do you see it will create some imbalance in the medium term? Or can metro-centric expansion continue without creating pockets of overcapacity? Or maybe, what more needs to be done to drive a sustainable capacity creation, in the next medium term, if we speak about?
No, so I think, clearly, as I told also, the focus will move from metros to outside metros after this phase. You will see a 3 to 4 year, focus on metro expansions. But beyond that, you are going to be seeing non-metros also going to be very important. It will start with the tier one cities, then it will move into the tier twos as well. So let's appreciate that, India needs a lot of hospitals. There's no doubt about it. If you look at the total number of beds that India has at around 20 lakh beds, 12 lakh beds out of that 20 lakhs is really coming from the private sector, with 8 lakhs really coming from the government. Out of the 12 lakh beds that India has, it's a very fragmented market, right? If you look at the organized care, it's only around 10% of 1.2 lakh beds. There is a lot of focus on organized care. The quality of care is moving up significantly in the organized market because, as someone said, maybe Keshav, that the technologies that you need to bring in, the kind of medical equipment that you need to bring in, and really go into the market today is at a much higher level compared to what was several years back. You will automatically see a lot of shift from unorganized to organized, which is what you're seeing. If you look at all of us put together, your analyst said 50,000 beds with all the 9 listed players, and all of us were putting up 15,000 beds. What are we speaking of? 8 lakh, 12 lakh beds in India, of which, 10% is in the organized. We are all put together just around 50,000. So there's a lot to be done. It's just a start of what we need to continue to work on. It's not an easy industry, hugely capital intensive, underappreciated by a lot of people on capital intensity. Today, if you look at it, many of us are now in capex phase, as you have already seen. And in the next 3-4 years, unless we will have to start recouping some of this capex to be able to then put it back into the non-metros. It's not an easy industry. Again, I'm saying, and we need beds outside of metros. There is a lot of government support required, as Samir said, which is not yet coming at the pace at which it should ideally come. If the IT industry of the past is where it is today, it's because of the lot of support that it received. Today, the same is probably required in healthcare at a much higher scale, because unlike IT, which didn't have this level of capital intensity, this requires a much more higher levels of capital intensity, capitals and allocations towards that. And, I think a significant rethink on some of this has to happen even at the government to see how to support the industry for us to be able to grow outside of the metros as well. That's what I would say.
Sure. Thank you. Thank you. Thank you for that insight. We move to you, Samir. We were talking about the medical tourism. We've already spoken about capex and all. In your view, does medical tourism have that potential to be the top, 2 to 3 growth engine kind of a thing for the sector? Though there is a lot of potential out over there, but you see it, to remain as a more of a opportunist stream, or it would be a growth engine for the sector going forward?
So, Ravleen, I think so. Different people on this call will have different answers, could have different answers depending upon their intensity of which markets they are operating
Sure.
in, right? If you look at medical tourism, it may be what, $7 to $9 billion overall market, right? India
Yeah.
controls maybe 20%. I'm saying even if you look at the slide deck that you guys prepared, on an average, 8 to 10% of the total revenues is coming from medical tourism. So saying that it is the top three is a challenge, because what happened is during COVID, everything sort of shut down, right? And then even if you look at your own chart, today, if more than 7 lakh people come from medical tourism, that is approximately the same amount of people that came in 2019.
Correct.
So practically in the last 6 years, there has been hardly been any growth. In medical tourism, the other challenge is, Ravleen, is the cash component, right? Everybody of us wants to do cash because there is very little chance of recovery in case if there is a credit, as far as because there is no mechanism for recovering credit. So I think so the medical tourism from a country specific needs to be more organized. There has to be more laws behind it, and the country has to be behind it.
Hmm.
Currently, I feel most of the private hospitals are going at it by creating their own markets abroad. Unlike a Thailand, where the government of Thailand actually went out and propagated about Thailand as a country for medical tourism, and then they build visa systems and infrastructure around people coming to boom boom tang, and there are many very very high class hospitals in some of these countries, like in Turkey, in Singapore, in Thailand, where the government has got behind and created the infrastructure to be able to attract the people from medical tourism. I personally believe that a lot of medical tourism that comes to India is from SEC 2 and 3 kind of people. So people from Bangladesh, Africa, those CIS countries come. I don't think so. Even though your analyst was quite positive in saying people from Britain and US are coming, I don't think so that's happening. That's maybe more happening because they come to the country and then they fall sick. I
Already
don't think so
below.
as a medical tourism we have created. Secondly, there's a lot of geopolitical issues happening. So visas are getting granted, not getting granted, which we saw in case of Bangladesh. After whatever happened in Bangladesh on the geopolitical, I think so we realized that the e-visas are not coming through. Then they come through. So for a hospital to depend upon medical tourism, I do not see that as to be honest, as a lever. It will remain an opportunist lever where some of the hospitals will dedicate some of their facilities towards providing a specialized care to people coming from outside. But I think so there is enough and more demand in the country. I think so there is the kind of population that the country has today. If you look at Amazon and Flipkart data, most of the growth is coming from tier 2, tier 3, right? And like for example, in Manipal, maybe more than 40 to 50% of our beds are in tier 2, right? And we see a lot of growth coming there. But unfortunately, sometimes the government comes and gives in free cards for free healthcare service, and those kind of issues happen in tier 2, tier 3. So, but from a medical tourism perspective, though it is growing at say maybe faster than others, but the base is small. But I think so a lot more needs to be developed on a policy side, from a government to be able to market and create the infrastructure for creating high value add healthcare. I once
Agree.
again say, Evelyn, I think so India healthcare can do practically everything that a Singapore or a Turkey can do, right? But
Sure.
why do some of the high-end people, even if you look at Malaysia, a lot of people from Bangladesh who are the high-end Bangladeshis who are very rich, they will actually prefer to go to a Malaysia or Turkey and not come to India, or
Hmm.
they will go to Singapore. There are 15 flights from Bangladesh that go to Malaysia, which is insane, right? So I'm just saying that still India needs to get up the ladder to get those kind of patients that add value. But some of these countries have added the tourism to the medical and created that as a package. For example, people will go to Thailand for tourism, and then they will include medical. So medical tourism are two words built into one. If the infrastructure and we create the e-visa system for tourism with built-in medical, I think so the sector can grow very fast. But currently, according to me, will remain an opportunist state. I don't think so. My next year planning can depend upon X amount of people
Sure.
coming from, though it does happen that way. But there are a lot of changes that happen in geopolitics which sort of prevents that from happening. So that is my sense on that.
No, that's a good and a different perspective. Keshav, would you like to add on, because Max does have a significant mix coming from the international and many of the metros hospital. So India still ranks, yeah, close to ninth or 10th in the medical value tourism. What are your thoughts? Would you like to, or do you concur with Sameer?
Completely nothing to add. I think it's short of time. Just that, yeah, we are today a destination of need as a People who don't have too much money, they need to get treated. Healthcare of India has already delivered the best of the director general medical directors of US, UK. When a doctor enters a room in US or UK, more than half the chance he'll be an Indian. Same for a nurse, be it Australia, Middle East. So medical talent is proven. The best of the guys, they will just like an engineer. You know, if you pick up a phone and call engineer, it'll be half the time an Indian only on the other side of the call. Same thing for doctors. I think we have to sell India as a country, as a destination. It's a safe, it's desirable, it's on the price point we are communicating, it's the complexity. Like Sumit is right bang on. We deliver more clinical service because our people are more trained. The kind of volumes they handle, it's behemoth. We just need to communicate and convince the world about the India as a destination of choice. What US, UK come today are marginal people. They'll come because they have home base here, they are Indian settled there or something, but it yet needs to be sold. And wo aayega. They are bursting at their seams, their government healthcare system are bursting at the seam, be it Europe, be it US, they'll all have to converge to India some stage or the other. I don't have a doubt about it.
Great.
I have one question for
Yeah.
Mr. Krishnan. What are the kind of regulatory and policy changes that you'd like to see that can strengthen resilience for the sector? Especially with respect to infrastructure creation as well as creation of a manpower supply chain. I mean, what are the kind of things that maybe a couple of asks that you would have from the government or the policy side?
See, if you look at today, for us, one is, we have been, if you look at the equivalent of a PLI, which is a production linked incentive that you have in India, can be considered by the government. In some way or form, there is an incentive which we need to give for creation of capacity in some way or form, which is, for example, in the past, we had this 150% of the capex that was put up by the hospitals was given as depreciation. So 50% was an additional allowance in some way or form, which was adjusted in the P&L, and the effective tax rate used to come down, which means you're incentivizing creation of capacity. And you could even, say that we would do it more for the non-metros, keep the 6 metros out, for example, and work on outside of the metros. That could be one of the examples. The second example, GST, of course, we all have been asking for it, because GST is a embedded cost in our P&L, which, from the consumer side, they believe, hospitals are in the zero or a negative list of GST, whereas our input costs all have GST, right? And the embedded GST is very high. One of the other things is, if you look at even leases, if you want to do an asset light model for hospitals today, it's very difficult, because on top of the yield, we will have to pay an 18% on the GST, which then becomes a yield of, say, 10% is a yield, it becomes 12% just because of the 18%. Like the education sector, we have been saying, at least give us some input GST breaks. One could be for leases, something could be for, F&B and housekeeping. We are hugely resource intensive, as I think Samir said, or we were, if you look at it, it's five people per bed. Many people again, equate the hospital room charges to a 5-star room charges, and then say that our room charges are high. What people don't understand is a 5-star hotel employs 1.5% at best per bed or per room, whereas we employ 5 to 6 people per bed or per room. So hugely resource intensive, hugely technology intensive as well. So clearly that's the reason that so there should be certain incentives which can be equivalent to push more capital and capex in the sector. Something on the GST front could be welcome. And as Samir said, on the medical tourism again, medical value travel, let me say, not tourism, Samir, as you said rightly. If you look at a medical value travel, we need some push on that front also, because we are all very proud to say that we can do what the best of the worlds can do, in terms of treatment. So I think there could be some push around some of these from the governments.
Yeah, thanks. That is very interesting perspective. Now, I have one, question for, Mr. Goyal. What are the innovations in, on the workforce side? Things like AI tools, telemedicine, remote diagnostics. Do you think these innovations can have, reduce your dependence on scarce talent, or, make the talent pool available go a longer way in addressing the healthcare needs?
There is lot is happening in this field on the innovation side, especially in the telemedicine side and home care and things like that. And I think going forward, the things will further improve here. But I don't see much change because healthcare is a more of a personalized type of thing. We are seeing lot of innovation on the technology side, where more and more procedures are getting a sort of simplified, where the robotic surgeries and things like that are happening, where the patient very precise surgeries can happen, and as a result patient stay at the hospital may be minimized. Beyond that, I don't see there is much innovation scope, because it is a more personalized type of thing.
That was all from my side. Ravleen, you have any more questions?
No. We'll just take the participant questions. We're already running out of time. A couple of them are repeated. Mr. Krishnan, this one, I'll post to you. One of the participants is asking quite an interesting one. Would the hospital chains consider building 3, 4, 5 stars in terms of complexity to address the demand? And this may help reduce the insurance premium for patients or load management for hospitals. What impact, do you see from traditional medicine-based hospitals in the medium term? How was it, in the nascent stage but catching on?
No, so I think I think it's very wrong to look at hospitals as stars, because
Yeah.
clearly, when you look at hospital, we all of us are very, very clear that patient experience and patient outcomes are at the center of what we are going to be doing. What matters for us is only that, right? Because when a patient comes into a hospital setup, we all understand that he's really going through pain, he's going through a lot of trauma, and what we need to do as a system is to first, bring down his pain and ensure that he's treated well and his outcomes are the best. The stars are really not matter at all. Here what happens today in India is, given the kind of land cost and the building cost that you have, the kind of infra that we put today is still, really not, we may call it 4 star and 5 star, but let me give you an example of Saudi Arabia, which is going through a sea change in infrastructure over the last 5 7 years. The kind of hospital beds that you are seeing there and the hospitals that you're seeing there will put us to shame. And I mean it, because it is 5 and 10 times the size of India. The Indian hospitals, that's the kind of size at which they are building. We are not able to do that because we are very cognizant about the affordability of the population. We are very careful about what we want to give to the population at the right best care, and we come back to say that we are a very affordable system overall, for the quality that we are able to provide. And I would really say we should be 5 star in quality and not anything else, and that we think we all are, I think, and we should be very proud about that as a system. And yes, every hospital system, whenever we enter, there are disappointments, because all of us go there with a set of expectations and we are under a set of pain. And at that point in time, in a system like what we have with so many patients, you are more likely to be, having issues than otherwise, and you see those issues more than otherwise. We know that where we had engaged a consultant long time back, and they said we should look at the Walt Disney experience. You Walt Disney, you go for excitement and fun and celebration, your mind is open to do certain other things. How will you bring a Walt Disney experience at Apollo? It's impossible. But yeah, we try to embrace that. We are patient focused, and I think we will continue to do that. And there will be various types and models of care which will emerge with time. You will see single specialties, you will see other specialties. All of those are the ways that care will be separated.
Ratings would be there. Yeah, okay.
And
Great.
Ravleen, I just wanted to give you a data point, since you are CFOs,
Sure.
and we love to give you data points. For any industry, you tell me which industry, including yours, is it working at Six Sigma levels, right?
Yeah.
Six Sigma levels is 3.3 defects per million. Can a hospital afford to lose 3.3 lives for every 10 lakh lives that it does? So whenever anybody walks into the hospital, expects to come back alive, expects to be treated. So
Yeah.
pressure on the system at the hospital is to work at beyond Six Sigma levels, right? We are working almost like 100%. Every life is important, needs to be saved. And again I say, sometimes the healthcare, 75% of the capex is proved by private healthcare in the country today. We become an underappreciated sector, because The reports that come out in the paper is a one-off event that happens everywhere, and not about the millions of lives that get saved. And that is something that, beyond the 3, 4, 5 star is about the lives that we save, and we do not work on a Six Sigma level that most industries work at.
No, no, sure. I believe that participant would have, well noted your points, Samir. We stay with you with this last thing, and this is something which, we maybe, as any of the credit rating agencies would be taking up with you on discussions, and something that, puts us, or scares us a little. Government, on and off, keeps discussing unifying the treatment rate across all states in India. Should this impact the pricing power of the private hospitals? These, in many ways, participants have put these questions. I'm just kind of consolidating and posing this one to you. And maybe if after you, if anyone else would like to take this up, and maybe that's the last we'll take.
That's a very actually a little bit of a controversial question to be asking on a platform like this. But my honest opinion, and I would defer it to my other colleagues on the call, that there is not possible to have a unified pricing system across facilities across the country. There is different equipments, different sets of doctors, different treatment. Each human body, one versus the other, is not the same. So if you give a paracetamol or a dolo that you understand as a brand to me versus given to your son could work differently in the body. Just to ensure that you have a unified system across the parameter is actually does even a hotel have a common rate across the country? It doesn't, right? A hotel in Bombay has a different rate versus a hotel somewhere else. So this unified system is actually just put it out there. I think so. A lot needs to be worked out
No.
to find. I think so. This is also a matter of Krishnan. I don't know if I'm right. It is a matter of sub judice as well in a way. Unified system in a country where the only has private healthcare only has about 10% of the beds. I don't know why we even talking about it. We are less than 10% of the overall beds in the country. So I don't know. So that is my point. Unified system, I think so. We are a little way off. I don't think so. It's true. We have to first understand how the healthcare costs come about. That's why some of the only 46% in as per your chart are gone with the Ayushman Bharat scheme,
Yeah.
because there is under appreciation of the cost involved in delivering healthcare itself. Otherwise, why is not 100% of the people on Ayushman healthcare, CGHS, working capital costs? Nobody looks at that, right? Today, when we treat people of ex-army men, which ideally the government should do, but we as private healthcare actually provide that cost, the payments are received after 6 months. Nobody sort of gets to know that. Nobody reports that from media. Nobody talks about, we are having significant AR in our books up to 20 to 30 days of AR. So I'm just saying it is not, according to me, it's not possible to come out with a unified system. I think so. Each of the insurance company anyways negotiates with each of the hospital, which is also, I do not know how the methodology is used, but that will be my view, Ravleen. But it's a good concept. But I think so. A lot needs to be worked on. There needs to be a lot more trust between the hospital, the insurance sectors, and the regulators to come up with the scheme that all three are sort of protected, because the entire capital cost is going from the hospital side, and nobody is more vested in it than the hospital sector in that sense.
Sure. No. Thank you.
Ravleen,
Thank
I'll
you so
just
much.
add one more thing.
Sure,
If you look
sure.
at it, so much of service intensity in the hospital, so much of service intensity there are so many grades of hospitals, right? If you look at it, if you come into most of the systems that you're currently talking with and you enter it through the emergency room, you're going to be seen in the 30th second. 30th second, I mean it. Whereas if you go into some other system, you would not get attention even for for 10 minutes and 15 minutes, because we put resources to take care of ensuring that you are taken care of at the 30th second. It's a high possibility that if you come with an MI, you may be addressed in the 15th minute, to go into the OT, and you will be going through the procedure. That's because we have redundancies and doctors available, and we just put someone to ensure that you're taken care of in that requirement. It's not that the doctor is going to be called from outside and he's going to take 30 minutes in if it's Bangalore, it will take him 1 hour to come. I'm just making it up, but I'm just saying that the kind of redundancies that we build is underappreciated. If it's a tech redundancy, if the technology which is there, so there is so much on costs. It cannot be the same cost for it cannot be unified.
Call
That's
out for
the
a
supply
unified.
side. And from the person side, as Samir rightly said, there is each person is different. There is comorbidity, there is severity. You know, if you look at insurance premiums, no one questions as to why a 30 to 40-year-old pays a different premium compared to a 50 to 60 and a 60 to 70 and a 70 to 80. It's not without a reason that the insurance premium changes, from bracket to bracket. Whereas, we are expected to give the same price even if it's a 40-year-old or a 60-year-old. How can that be? Your comorbidities are different, your severity is different, complexity of case is different. It is impossible.
Sure. No, those replies are well appreciated. I believe many of the participants had this, query and should be answered for them. Thank you so much. And over to you, Mamta, for closing the session.
Thank you, Ravleen and Sabyasachi, for moderating the session. Once again, we thank all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us at the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.
Thank you.
Thank you.
Thank you, everyone. Thank you, everyone, for making
Thanks.
taking
Thank
time.
you so much.